deductions most owners miss. If you own an assisted living facility, here's the harsh truth. You're almost certainly overpaying taxes every year. And it's not because you're careless. Hi, I'm Larry Davis, founder of Tax Help. We help assisted living and healthcare business owners to clean up their book, reduce their tax bills, and finally get control of their finances. It's because most owners never realize that IRS gives healthcare businesses unique deductions that general accountants don't know about. Think about your daily operations. You manage care-based payroll, maintain medical-grade facilities, comply with state regulations, invest in safety and training, buy equipment, and constantly improve the resident experience. Each of these areas has deductions built in, but the IRS doesn't advertise them. In fact, they don't send a memo saying, hey, you're missing $50,000, $100,000 in potential deductions. I've spoken to dozens of owners who were shocked to discover this. One owner running a 16-bed facility told me, I thought I was deducting everything I could, but my CPA never even mentioned things like specialized payroll credits, cost segregation, or healthcare specific asset depreciation. After just one tax review with a healthcare-focused strategist, she saved $76,000 in taxes that year alone. The problem isn't that the deductions don't exist. The problem is that general CPAs don't understand the nuances of assisted living and healthcare tax law. Today, I'm going to walk you through 10 hidden deduction opportunities using real scenarios, frameworks you can implement, and before and after results. By the end of this video, you'll see exactly where you might be losing thousands and how to reclaim them legally. Facility building tax advantage. Many assisted living owners see their building as just real estate and depreciate it over decades. That's a huge missed opportunity. Healthcare buildings are made of numerous components: flooring, plumbing, lighting, security, medical stations, elevators, each of which qualifies for accelerated depreciation under cost segregation. For example, we worked with a 20-unit assisted living facility that operated for 7 years without this strategy. After performing a cost segregation study, we reclassified the building's components. Suddenly, $68,000 of taxes could be deducted in just 1 year. The framework is simple. Treat your building as a collection of depreciable assets rather than a single property. Identify each component, assign IRS-approved depreciation categories, and accelerate deductions. By doing so, your facility becomes not just a home for residents, but a strategic tax asset. Most owners don't know this exists because general CPAs don't specialize in healthcare property codes. Using this strategy isn't risky, it's completely IRS approved, and it can immediately improve cash flow. Care-based payroll credits. Payroll is usually the largest expense for assisted living facilities, but most owners think of it as a simple cost. The reality is that caregiver payroll can qualify for specialized tax credits, especially if it's tied to compliance ratios, patient care hours, or wellness programs. We helped a facility with $1.2 million in revenue restructure payroll categories. By documenting staff roles and linking them to IRS-approved credit categories, they discovered $44,000 in payroll-based tax credits, not by hiring new employees, but simply by classifying payroll correctly. The strategy is about documentation and structure. Track employee roles, care hours, and compliance status, then match each to the correct credit category. Quarterly audits ensure nothing slips through the cracks. Careful payroll management can turn your biggest expense into one of your largest tax savings opportunities. Fully deductible compliance. State regulations for assisted living facilities are strict: fire safety, emergency alert systems, ADA compliance, security cameras, nurse call systems. Many owners assume these are capital improvements or renovations and write off only a fraction. One facility spent $120,000 on upgrades, but her general CPA only deducted $18,000. By applying healthcare-specific compliance codes, we were able to deduct the full $102,000. The framework here is about perspective. Compliance is not just a legal necessity, it's a deduction opportunity. Every system, upgrade, and installation should be categorized under care facility improvement codes. This approach doesn't require changing operations, just labeling and documenting correctly. Medical equipment depreciation. beds, lifts, monitoring systems, oxygen machines, all equipment necessary for patient care, often categorized as general business assets. That means they are depreciated slowly over many years. In healthcare, however, these assets can be accelerated, allowing you to deduct large portions immediately. A 16-bed facility reclassified all medical equipment and reduced taxable income by $40,000 in the first year alone. The key is taking a full inventory, identifying which items are medically necessary, and applying accelerated depreciation schedules. Equipment you already own becomes a tax tool rather than just a cost. Staff training tax deductions. Every caregiver undergoes ongoing training, safety protocols, medication handling, dementia care, CPR certification. Many owners never deduct these expenses, assuming their operational costs. We helped a client who spent $22,000 annually on training but never claimed it. After implementing a structured log and categorization system for certifications, she began deducting $7,400 per year. By systematically tracking staff training, documenting certification hours, and categorizing expenses properly, your investment in staff can reduce taxes annually while keeping your care standards high. Resident experience tax benefits. Enhancing resident comfort and wellness, sensory rooms, therapy areas, calming furniture, or even wellness programs can be deductible under patient care improvement codes. One facility spent $55,000 upgrading common areas, but only deducted $10,000 with a general CPA. After reclassifying expenses correctly, the full $55,000 became deductible. In assisted living, quality of care is a tax advantage. Proper classification turns operational investments into financial benefits. Marketing as health education. And marketing is usually treated as advertising expenses, but when positioned as community health education, like wellness classes or senior care information campaigns, it may qualify for healthcare-specific deductions. We helped an owner shift messaging from "we provide care" to "we provide wellness education." The same advertising spend became fully deductible. This shows that how you describe your marketing can directly impact tax treatment. General CPAs cost owners. Assisted living is complex. Compliance-driven deductions, staffing-based tax structures, licensing, Medicaid alignment, and healthcare-specific asset codes. General CPAs often ignore these. One owner used the same CPA for 8 years and, after switching to a healthcare-focused strategist, saved $52,000 in the first year without changing operations. You don't just need a CPA, you need a partner who understands healthcare tax law, audits your facility regularly, and proactively identifies opportunities. Quarterly tax review system. Reviewing taxes only once a year is risky. Changes in payroll, staffing, and expenses happen constantly. Small errors compound quietly and can result in tens of thousands in lost deductions. We implemented a quarterly review system for one facility. Every 90 days, we audited payroll, expenses, deductions, and projections. Within 1 year, over 30 adjustments were identified, improving profitability and reducing taxes. By reviewing consistently, owners gain control, reduce mistakes, and ensure deductions are maximized in real time. Owner compensation tax strategy. Most owners pay everyone else first, staff, vendors, taxes, and leave themselves last. Properly structured compensation can be a tax strategy. One owner earning $200,000 per year set up a defined benefit plan. This reduced taxable income while building retirement savings, lowering the effective tax rate and improving long-term financial security. In healthcare, your personal financial planning should complement your operational planning. Proper compensation strategies allow you to benefit personally from the hard work you already do for residents. Assisted living owners work tirelessly to care for residents, but many leave thousands on the table because the IRS doesn't advertise healthcare-specific deductions. General CPAs rarely use them. The key is industry specialization, documentation, and proactive strategy. By identifying healthcare-specific deductions, tracking and categorizing them correctly, implementing quarterly reviews, and planning owner compensation, you don't just save taxes, you gain control, confidence, and long-term financial stability. Your facility isn't just a business, it's a healthcare operation with tax rights the IRS honors if you claim them correctly. If you're a business owner struggling with back taxes or IRS debt, hit subscribe right now. Every week I share real strategies to legally help you reduce what you owe. Also, we'll send you our 10 tax strategies for assisted living and healthcare businesses to reduce their tax bill just for liking this video.